$2 million. Say it slowly. Let it land. $2 million. That is what it cost me to learn one trading rule. Not a system, not 1,000 indicators, or what a secret algorithm whispered in the back rooms of Wall Street. One rule, sitting in plain sight, that more than 90% of traders have never truly grasped, even 100 years after I bled for it. And the cruelest part, those same traders are still making the exact same mistakes today, losing the same way, on different assets, different platforms, different screens, but the same fundamental error, over and over. I am Jesse Livermore. You may know me as the boy plunger, the kid who walked out of the cotton fields of Massachusetts, sat down with $5, and eventually built a fortune that made Wall Street take notice. I made millions. I lost millions. I was broken, rebuilt, and broken again. But this one lesson, this single, brutal, expensive lesson, is what changed everything for me, and I am giving it to you today, for free. Because the market has already taken enough from enough people. Stay with me. By the time we are done, you will see your charts differently. You will trade differently. And the mistakes that have been quietly draining your account, you will finally recognize them for what they are. Are you ready? Then let us go. Before we dive in, I want you to do something. Think back to your last losing trade. Do not just remember the numbers, remember the feeling, that heavy, sinking sensation when the price moved against you. Maybe you held on a little too long, telling yourself it would bounce back. Maybe you jumped in too fast because something felt right. A headline or a tip screamed opportunity, and you chased it like a dog chasing a car. Sound familiar? Here's what I need you to understand. That was not bad luck. That was not a broken indicator or a rigged market. That was you fighting something you were never meant to fight, and I paid $2 million to finally learn what that something was. In my early trading days, I believed success came from action. Always in the market, always chasing the next move, always trying to get in before everyone else caught on. I bought on rumors. I chased tips from men who barely knew more than I did. I tried to call tops and bottoms like some kind of fortune teller, buying because the stock felt cheap, shorting because a rally felt too extended. Sometimes I won big. The wins felt like genius, but the market has a way of humbling genius. Every time I fought the market's direction, it punished me. Every time I thought I was smarter than the price action on my charts, I paid for that arrogance. And after one devastating stretch, losses that piled up until $2 million had vanished from my account, I finally stopped and asked myself the honest question I had been avoiding. What am I doing wrong? The answer, when I finally faced it, was right there on every chart I had ever looked at. I had not lost because of bad luck. I had not lost because of poor timing or bad information. I lost because I had been ignoring the most obvious signal in front of me, the direction the market was already moving, and replacing it with what I believed should happen. That was the mistake, and it was costing me everything. So what is the $2 million rule? Here it is, simple as I can make it. Endeavor, fight, the trend. That is it. Now, before you roll your eyes and say Livermore, I have heard this 1,000 times. Hear me out. Because what sounds like a bumper sticker is actually the hardest discipline a trader will ever attempt. Not because it is complicated, because following it requires you to go to war with the most dangerous opponent you will ever face in the markets. Yourself. The trend is not just a line on your chart, it is the market's collective voice, the sum of every buy order, every sell order, every piece of information acted upon by every participant in real time. When a stock is trending up, buyers are in control. When it is trending down, sellers are in control. And when you trade against that force, you are swimming upstream against millions of decisions made by people with more information, more capital, and more conviction than you. The market is bigger than you. It is stronger than you, and it does not care about your opinion. Your job is not to argue with the market. Your job is to listen to it. So if the rule is so simple, why does almost everyone break it? Let me show you exactly what fighting the trend looks like, because I guarantee you will recognize yourself in at least one of these. Fighting the trend is buying a stock that has been falling for 3 weeks because it looks cheap on your screen. Fighting the trend is holding a losing position while the price drops lower and lower, telling yourself the fundamentals are solid and the market is wrong. Fighting the trend is shorting a stock that keeps making new highs because you have convinced yourself it is overbought, only to watch it climb another 30% while your account bleeds out. Fighting the trend is revenge trading after a loss, forcing your way back into the market before it is ready, just to recover what you lost. It is jumping into a parabolic move at the very top because you are terrified of missing out and then becoming the exit liquidity for everyone who got in early. Every single one of those scenarios has one thing in common. You are deciding what the price should do instead of letting the chart tell you what the price is doing, and the market without fail will correct that mistake at your expense. Here's what nobody talks about enough. Fighting the trend is not a technical problem. It is a psychological one. When you look at a chart and see a stock that has been falling for weeks, something in your brain says opportunity. Because we are wired as human beings to seek bargains, to buy low, to feel smart when we catch a turn before the crowd does. But the market is not a store. A stock that has fallen 50% is not necessarily cheap. It might be in a brutal downtrend with momentum that will carry it down another 50%. The chart will tell you which one it is, if you are willing to listen. Greed says, hold on, it is going higher, do not miss the move. Fear says, get out now before you lose everything. Ego says, you cannot be wrong. The market will come back to you. These voices are not instincts, they are ENMIs, and the entire game of professional trading is learning to replace those voices with one single question. What is the chart actually telling me right now? I call this mastering your inner analyst. Not the loud emotional one who reacts to every candle. The quiet, disciplined one who reads price action and acts on evidence, not feeling. That is the skill. And it is a lifelong study. So how do you actually read a trend? Let me break it down in steps that any trader on a modern platform can apply today. Step 1. Define the trend with price structure. Forget complicated indicators for a moment. Look at your chart and ask one question. Is price making higher highs and higher lows, or lower lows and lower highs? Higher highs and higher lows? That is a new trend. Buyers are in control. Each pullback gets bought up before it erases the previous low. The market is climbing a staircase. Lower lows and lower highs. That is a downtrend. Sellers are in control. Each rally gets sold before it can recover the previous high. The market is falling down that same staircase. If it is choppy, sideways, no clear structure, that is a ranging market. An arranging market has no business with your hard-earned capital in it. Stand aside. Step 2, confirm the trend with volume. Volume is the market's heartbeat. It tells you how much conviction is behind a price move. In a healthy uptrend, volume expands on the up days and contracts on the pullbacks. That means buyers are aggressive and sellers are passive. A strong trend. In a downtrend, volume expands on the down days and fades on the rallies. Sellers are in control, and every bounce is a selling opportunity, not a reversal. When volume contradicts the price move, when a stock rallies on thin volume or falls on thin volume, the market is sending you a warning. That move may not have legs. Step 3. Trade with the trend, not against it. Uptrend, look to buy pullbacks to support the dips where buyers have historically stepped in. Do not chase breakouts into thin air. Downtrend, either short the rallies or step aside entirely. There is no shame in being out of the market. I have sat on my hands for weeks waiting for a clear setup. That patience has made me more money than any clever entry ever did. Step 4. Define your risk before you enter. Before any trade, know exactly where you are wrong. What price level, if breached, tells you the trend has changed. That is your stop loss. Set it, honor it. Do not move it because the price got close and made you nervous. A stop loss that gets moved is not a stop loss. It is a hope, and the market has no mercy for hope. Step 5. Protect your capital above everything else. This is the rule behind the rule. Trading is not a single game. It is a career. A trader who loses 50% of their account needs 100% return just to get back to even. Protect the principal. Cut losses quickly. Let winners run. It is unglamorous, uncomfortable, and absolutely essential. Let me show you what this looks like in practice. In 1907, one of the most volatile years in American financial history, panic swept through the markets like wildfire. Stocks were dropping. Rumors were flying. Fear was everywhere, in every trading room, in every conversation, on every face. Most traders did what traders do in a panic. They reacted. They sold into the fear, or tried to catch falling knives, or froze entirely. I went back to my charts, and what those charts told me, underneath all the noise, all the emotion, all the headlines, was this. Prices were still making higher highs. Volume was surging on the advancing days and thinning out on the pullbacks. The overall trend was einticked. The structure of the market had not broken, only the mood had. So I held my positions. I did not panic sell. And when the fear subsided and the market resumed its upward march, I did not just survive. I made a fortune. Not because I was braver than everyone else, because I was disciplined enough to trust my chart over my emotions. That is the difference. Every time. Now let me warn you about the specific traps that will make you fight the trend even when you know better. Because knowing a rule and consistently following it are two very different things. Trap 1. Overconfidence after a winning streak. After a string of good trades, the mind becomes dangerously seduced by its own brilliance. You start to believe the wins came from your skill, your superior reading of the charts, your timing, your edge, and the moment that belief takes over, you stop following the trend and start following your ego. You get sloppy. You take trades that are not there. You hold losers because you are certain the market will vindicate you, and it will not. The market does not care how many trades you won last month. Trap 2. Fear of missing out. FOMO. The chart has been consolidating for days. Then it breaks out sharply. Price is moving fast. Your feed is going crazy. Everyone seems to be making money on this move right now, and the fear of being left behind overwhelms your discipline. You buy at the top of the candle, at the peak of the move, right as the early buyers are taking profit and looking for exits. You become their exit. FOMO is one of the most expensive emotions in trading. The antidote is simple in theory and hard in practice. If you missed the entry, you missed it. There will be another setup. Protecting your capital is always more important than chasing a move you did not plan. Trap 3. Revenge trading. You took a loss. It stings. The impulse to recover it immediately on the very next trade, doubled down, is almost irresistible. But a trade entered to recover a loss is not a trade. It is a gamble driven by wounded pride. The chart does not care that you are angry. The market does not owe you a recovery. Revenge trading turns small losses into catastrophic ones. I have been there. It is a very dark place. All three traps share one common root. They are about you, your ego, your fear, your impatience, not about what the chart is telling you. And the moment a trade becomes about you instead of the price structure, you have already lost. Let me give you one more concrete example. This time from 1914, when the world was sliding into the First World War. The markets were volatile, violent swings, false moves everywhere. News was changing by the hour, and traders were getting whipsawed trying to react to every headline. But I went back to my charts, and the charts were telling a clear story. Lower highs, lower lows, heavy volume on the declining days, thin volume on the rallies. The trend was down. Not ambiguous, not maybe. Down. Most traders around me were trying to pick the bottom. They would see a short-term bounce, convince themselves the selling was done, buy in, and then watch the next leg down crush them. Over and over. Stubborn, expensive, emotionally driven buying against a clear downtrend. I did the opposite. I positioned myself on the short side, following the direction the charts were already pointing, trailing my stops as the trend extended. I did not know exactly how far prices would fall. I did not need to know. I only needed to know which direction they were going, and the charts had already answered that question. That trade made me a fortune, not because I was clever, because I listened to what was already there. I have to tell you something about 1929, because the $2 million lesson is not a lesson I learned once and never forgot. It is a lesson I had to relearn, painfully, more than once. By 1929, I had already made and lost several fortunes. I knew the rule. I had built my entire philosophy around reading charts and following trends. And yet, in the roaring bull market of the late 20s, I felt the pull of the crowd. That intoxicating mass delusion that the good times would never end, that the market only went one way, that this time was different. When the warning signs appeared on my charts, and they did appear clearly, I was slow to act. I held positions too long. I let the optimism of the era override what the price structure was telling me. I confused a market that had been in an uptrend with a market that was still in one, and I paid dearly for that confusion. I tell you this not to diminish the lesson, but to show you how powerful the psychological pull is, even for someone who knew better, even for someone who had paid $2 million to understand this rule. The lesson is never truly learned once and filed away. It is practiced every day, every trade, every time the market tempts you to override what the charts are saying with what you want to be true. Stay humble, stay disciplined. The moment you think you are above this rule is the moment the market will remind you that you are not. Let me talk about patience, because it is the other half of this lesson, and the half that most traders undervalue completely. Some of my greatest trades did not come from brilliant analysis. They came from waiting. There was a period when I had been watching a group of stocks for weeks. The public sentiment was bearish. The financial press was full of doom. The conventional wisdom was overwhelmingly negative, but my charts were telling a different story. Prices were quietly making higher lows. Volume was building on the up days. Something was accumulating beneath the surface. Big money moving in silence, buying while the crowd was too scared to. I sat on my hands for weeks. I did nothing while lesser traders thrashed around me, getting chopped up by the short-term noise. And then, when those stocks broke above their resistance levels with clear, convincing volume, I moved. I entered with size and confidence, because the chart had finally shown me its hand without ambiguity. I tripled my money on that trade, not because I predicted it, because I waited until the evidence was undeniable, and then I followed it. Most traders feel they must always be in the market. They feel that sitting out is wasting time, missing opportunity. But professionals know the truth. The best trades are the obvious ones. If you have to talk yourself into a trade, if you have to squint at the chart to see the trend, if you need 6 different indicators to confirm what the price structure is not clearly showing, that is not a trade. That is hope wearing a disguise. Sometimes the smartest trade is no trade at all. Let me tell you about the small percentage of traders who win consistently, not occasionally, consistently, year after year. They are not smarter than you. Many of them do not have better information than you. They do not have a secret formula, a magic indicator, or a proprietary algorithm that sees the future. What they have is simpler and rarer than any of those things. They respect the market. They cut losses quickly, without drama and without ego. They ride winners patiently, without panicking out at the first sign of a pullback. They do not argue with their charts. They do not hold a losing position and wait for the market to apologize. They follow the trend, not when it is convenient, not when it aligns with their thesis. Always. And the single most important habit they have, the one that separates them from the 90%, is this. Before every single trade, they ask themselves, am I trading with the trend or against it? If the answer is with the trend, they proceed with a plan. If the answer is against it, they step back, no matter how compelling the setup feels. That one question, asked honestly and answered honestly, is worth more than any indicator or strategy ever invented. Here is your challenge, a real one, for your next 10 trades. 10, not 1, before you enter. Ask yourself that question. Am I trading with the trend or against it? Be honest. Look at your chart. Look at the price structure. Higher highs and higher lows, or lower lows and lower highs. Is volume supporting the direction? Are you buying into a pullback within an uptrend, or are you trying to catch a falling stock because it feels cheap? If you are, proceed. Build your plan, define your risk, set your stop, execute with discipline. If you are against the trend, walk away. No matter how strong the feeling, no matter how compelling the logic in your head, the market will still be there tomorrow. Your capital, if you waste it fighting the trend, may not be. After 10 trades, review your results. Note what happened when you followed the trend versus when you did not. Let the evidence teach you what words alone cannot. The charts are always speaking. The question is whether you are listening or arguing back. Let me leave you with what took me the longest to truly understand. The market is not your enemy. It is not conspiring against you. It is not setting traps for your specific benefit. It simply moves shaped by the decisions of millions of participants, each acting on their own information, their own fear, their own greed, their own analysis. Your job is not to predict what it will do. Your job is to respond to what it is already doing. Prediction is arrogance. Response is wisdom. The greatest traders I have ever known, across every era, every asset class, every strategy, share one quality above all others: not intelligence, not access to better data, not even years of experience: humility. They know the market is always right, and they are sometimes wrong. They know their beautifully reasoned thesis is worth nothing if the chart disagrees. They take their losses quickly, without drama, without ego. They cut what is not working and let what is working breathe. And they wait patiently, deliberately, without flinching, for the market to show them a clear setup before committing a single dollar. That is the discipline. That is the entire game. The $2 million I lost bought me that clarity. It taught me that speculation, real, professional speculation, is not gambling. It is not guessing. It is the disciplined practice of reading what is already happening and positioning yourself in its direction. You are not here to be right all the time. Nobody is. You are here to follow the evidence, manage your risk, and let the math work in your favor over time. If you could go back to your worst trading loss, that one trade, that one moment, and whisper something to your past self, what would it be? I know what I would whisper. Look at the chart, not your feelings, not your ego, not the headline. The chart, because the chart does not lie. Price is always the truth. The real-time summary of everything every participant knows and believes at any given moment. And if you can learn to read that truth, to follow it without ego or resistance, you will have mastered something that 90% of traders never will. You will stop fighting the market, and you will start trading with it. Trade with the trend. Respect the trend. Never argue with your charts. The market rewards the patient, the humble, the disciplined. I hope today was worth your time. This is Jesse Livermore. Trade smart, trade disciplined, and never, never fight the trend.